Hi and good morning. Welcome to Real-Time Daily Trader Ideas. We have 5 days a week, 5 different traders, everybody with its different and unique trading style. Today it's Monday. Today it will be Jay's day. So welcome on Monday, 23rd of April 2018. We will have a nice start like every day, and we start with our risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. If you are a starter, please start with a demo account and make yourself familiar with long trading, short trading, and your personal risk management. If you'd like to read the full disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and everything you will find written down there. This is me. My name is Jens. I'm the German guy. I'm talking from the Berlin office from Admiral Markets. I'm a big international broker with over 18 country offices. So my English is made in Germany, but hopefully my quality too. But like I say every day, I'm not the main speaker. The main speaker is the day trader of today. This is our scheme. On Monday, like today, it's Jay's day. On Tuesday, it's Paul's day. On Wednesday, it's Giancarlo's day. On Thursday, it's Leonard's day. On Friday, it's DX day. Our leading day traders live every business day. And of course, if you'd like to trade Forex and CFDs, we would be happy if you do it with us. Many benefits only available at Admiral Markets. For example, if you like to trade with MT4 or MT5, it's your choice. If you like to trade with leverage of 10 or maximum 500, it's your choice. You can choose it. And one of our bestsellers, spread DAX 30, triple spread of just 0.8 points to the main trading hours. Check all details out on admiralmarkets.com. They will find also something about our regulatory background and how to contact us. You can call us, you can send us an email, or visit the other channels like YouTube or Facebook. Everything's linked from admiralmarkets.com. Enough from my side. Now it's time for Jay. Good morning, Jay. What's your view to the markets today?
Good morning, Jens. Can you hear me? Good morning,
Yes,
traders.
now I hear you.
Excellent. Outstanding. All right, let's show my screen and let's get rocking and rolling. Andrea, you're in? She doesn't seem to be in because usually every Monday morning she says good morning to you. She must not be in. Strange. Okay, hopefully everybody's all right. Had a wonderful sunny weekend. Let's get going. We still have a trade open from April the 9th, long Euro Aussie. Hopefully they're going to buy the liquidity above these swing highs. And good morning, Jörg. Off and on, we hopefully will rally. Overnight, we saw a recovery in the pound. Pound got battered last week, especially bad numbers. And then Carney came out and said that the market had got the pound wrong. And there was a probability above 80% for a rate hike of 25 basis points in May for the May meeting of the Bank of England. And that was priced out, and the probability dropped to around 40%, and the pound really got battered. So we're at a line in the sand. Hopefully the pound can hold here and recover. We will see. Early on this morning, we had a little bit of US dollar strength. So let's see what happens. We had already PMI numbers, and this is especially important to the equity traders as well, because the equity indices as well as the PMIs show a very high correlation. So we're still in expansionary territory over in Japan, and in Europe we had the flash manufacturing that came in a little bit below expectations, but on the service side we had a slight beat. So 1987 comes to mind. 1987, we had very high PMIs, above 50 in expansionary territory, but the equity market sold off anyways. In no shape, way, or form am I saying that we are running into a 1987 scenario, not at all, but I just want you guys to be aware that while PMIs are a leading indicator and highly correlated to the equity market, not necessarily does this mean that the market can tank with PMIs above 50. And then this afternoon, we have flash manufacturing and services out of the US, and a little bit of cooling on the manufacturing side and services side, a tiny little bit of an improvement. So we'll keep an eye on that. On to Tuesday. Tuesday, we have the very important CPI numbers out of Australia. But as we know, the RBA says, hey, we're in no time pressure to rush. Inflation pressures not really there yet. So yes, market, you are correct in expecting that the next hike is probably going to be up, but we're in no rush. So keep that in mind. And then we have core CPI. Bank of Japan will take a look at that slightly off. So in Japan, we have rising wages, but we don't have inflation in food and energy yet. Then we have the German IFO business climate. To note, they are rebalancing the IFO to the year 2015. So expect a lower number from that. Then on the pound side, this morning already with my traders, I had a discussion. Public sector net borrowing, the 1.1 billion, actually shows a positive number, but this is a budget deficit. So from last time a budget surplus to this time a budget deficit is actually bearish for the pound. Okay, Commitment of Traders reports also bearish on the pound, and the option market also bearish on the pound last Friday. And volatility jumped higher last Thursday. So the pound is an excellent currency to trade right now if you know what you're doing. Then on Tuesday afternoon, we have consumer confidence, the conference board indicator, not as famous as the University of Michigan, but still relevant. Then we have holy cow, hopefully my computer is not going to crash. Whoa. Let me know if you guys can't see or hear me any longer. It's making strange noises. CBI leading index out of China, and then we have Bank of Canada Polo speaking. Thank you, Modris. Thanks for letting me know that you're still online. Hey, there you are, Andrea. Good to see you. I was already mentioning that I missed your good morning this morning. Okay, Thursday then we have ECB bid rate, meaning the interest rate decision obviously expected to be unchanged. We'll allude to that in a little bit. And then in the afternoon, we have a whole slew of US data. We have core durable goods orders expected to be lower than last time. And last time already underperformed, came in lower than expected, hence the number is red. And then we have durable goods orders also coming off a little bit. Unemployment claims, I almost said as always, around the 230K. And then we have goods trade balance and preliminary wholesale inventories. Lower inventories is positive for the currency, by the way. Okay, one note here, a side note. The Economic Cycle Research Institute put out a note, recently put out a note stating that this global expansion, this global coordinated growth that we saw in global economies is cooling off. And there was an interesting research piece that I read that even in Europe, the peak growth is behind us. So that can explain some of the euro's weakness. Good discussion with my traders on that one as well. And then we come to Friday, we have trade balance coming in at 200 versus 217, so that's slightly less. Then we have CPI numbers and a whole slew of numbers out of Japan. That's going to be of interest to us. Recall that the Nikkei 225 has recovered nicely. PPI numbers out of Australia, and also please recall, I keep saying these things over and over again because repetition makes perfect. PPI is what is the cost that goes in the production value chain, and then at the end is the price that the consumer pays. And if the PPI rises, a lot of that can actually be passed on to the consumer. So hence, the next logical thought in your mind has to be, okay, if PPI rises and that cost is mostly passed on to the consumer, and if CPI is rising, is the consumer able, both of that actually means rising inflation, to compensate for that? Is the consumer getting paid more? Hence, the average hourly earnings number is so important every week when we look at the employment data out of the US, all right? Okay, and then on Friday, we have a rate decision out of Japan, also expected to be unchanged with the press conference. Then we have preliminary GDP out of the UK. That's going to be important, slightly lower than last time expected. So we'll see. And last but not least, we'll finish off the week with advanced GDP quarter on quarter out of the US. And there too, it's cooling. Even the leading indicators out of the Atlanta Fed are stating, hey, growth is cooling. So recall what I just said. Economic Cycle Research Institute stating that economic global expansion is coming off a little bit. Keep an eye on that. That means trading opportunities for us, but also keep an eye on equities because we had the best earnings season expectation ever for Q1 earnings, and hence we'll see what the next earnings season will bring to us. And be careful in case equities are toppish meaning at the top edge, meaning, you know, if they can continue to rise. I think they can, but we'll have to be careful. And then last but not least, all eyes will be Bank of England's Carney on Friday, 4 p.m. That means we're actually trading on Friday, because last week he was so dovish on the pound. It's going to be super interesting to see what he says there. Okay, Mr. Computer, let's go, please. All right, let's cycle through these quicker because I basically already said everything. We talked about the GDP coming in the US lower than expected. There is a reason for that, because delayed tax refunds caused a slower start to consumer spending, but these new tax cuts from Trump come into effect in the second quarter. So obviously that's going to be positive in terms of expectation. Euro, we talked about, the market is expecting the first rate hike somewhere in the middle of 2019, more towards the third quarter. Okay, during this presser, during this rate decision, I mean, the focus will be on language tweaks and what the ECB is stating in terms of weaker economic growth data that we recently saw out of Europe as well. German IFO is being rebalanced. We talked about this. Over to the pound, we have preliminary GDP coming in a little bit lower, and we already expected that because we saw the PMIs. That's also something that I want to reiterate to you guys. Within a bank, there's traders, and they sit there and they make markets, market makers. Okay, prop trading was sort of banned after the global financial crisis, and in the background, we have a ton of super sophisticated analysts, and these analysts comb through the data and the numbers. And so, for example, if we have an unemployment number on a Friday out of the US, our analysts have already ran their models, and they tell us traders what if it's going to be higher or lower. It's not, in most of the cases, it's not a surprise to us. So that this number, for example, is expected to come in lower is not a surprise, because the PMIs already signaled that. Why? Because we had some bad weather in March. Okay, and then recall that the pound really tumbled last week because we had some bad data, lower than expected wage growth. We had a softer forecast in terms of inflation and weak retail sales. And then Carney hit the mic and he said, "Hey, Mr. Market, you got us wrong." And then we tumbled. Rate expectations were priced out. Rate hike expectations out of the market. Aussie, RBA not expected to move. We see that the implied year-on-year core CPI based on the quarterly numbers come in lower to 1.8, and this is the 9th consecutive quarter where core inflation is sub 2% target. That's quite interesting. So hence the RBA no rush to hike rates. They need to be a little bit cautious here on inflation, and they expect inflation to only rise gradually. Nothing in terms of policy changes out of the Bank of Japan. Interesting is that while wages started to increase, food and energy has not, and the market somehow, me personally, I don't really know why, was expecting a policy normalization out of the Bank of Japan. My thinking is, since the market, Mr. Market, is like a 6-year-old with attention deficit syndrome, the market thought, hey, the Fed is normalizing, ECB starting to normalize, Bank of Canada is normalizing, Bank of Japan, very good solid equity performance there. So maybe they're going to start normalizing as well. I find that highly questionable because I don't see sustained rise in inflation over there, but maybe I'm missing the point. I'm just saying, let's be careful and see what the market versus the Bank of Japan argument is really coming to fruition. What happened here? Are we already done? Give me a second. Yeah, I guess we're done. Excellent. Okay, good. On to positioning and volatility. The Commitment of Traders report is showing us that in terms of positioning, the Aussie dollar is on the way to a potential long signal. Not quite there yet, but rather playing the Aussie from the long side. Pound short. So hit top edges. Kiwi on its way to a potential long signal, but not yet. And dollar long. Why? Because real money is ultra short, and the majority in the market is never long-term correct. Volatility rising in the euro, volatility rising in the pound, volatility coming off a little bit in the yen, and volatility coming off a little bit in the equities. Option pricing for this morning, long GU. Hopefully that bottom edge is holding, like I said. hopefully the pound can recover a little bit so that we can hit higher levels again. Euro dollar, dollar yen, euro Swissy, gold short for Monday out of the option pricing model that we follow. Option flows, we follow those as well. Bullish for the Monday London session, Aussie, pound, and gold. So you see a confluence here. The pricing as well as the flows are saying, hey, let's watch for if a bottom edge in the pound is holding, and bearish Canadian dollar, euro, yen, and Swiss francs. So let's see, the dollar is gaining, continues to gain in the London session. New Zealand and Aussie dollar getting hit in the London session so far, okay? What else can I show you? Okay, this is the dollar index. It's caught in a range, the DXY. 60% of the weighting is versus the euro. So you might as well put a euro dollar chart on here. But what I find interesting is that the 10-year treasury yield is edging towards 3% in the US. And that's going to be a major point hitting the 3%. And it's almost like a decision point. The market has to make a decision. We will have to look at the curve at the time when this is hitting, and then we can determine if the US equities are going to get hit. Yeah, meaning coming off, meaning falling in price. It's going to be a super interesting week this week in terms of US equities versus the outright 10-year yield level in the US. Potential trades, aggressive trade, long Aussie versus New Zealand. Aussie, we have tiny little bit trimmed mean CPI quarter on quarter coming slightly better than expected. Then the cut positioning is speaking towards more the long Aussie dollar, and we saw some very good strength in the commodity indices last week. So I expect continuation in that. Kiwi, we have trade balance slightly weaker than expected, and again, cut positioning speaking towards the short in the Kiwi. Trade structure, super aggressive, already long a starter position, and then there's one buy limit order resting below me, waiting on my side for a retracement. The best level for me would be, or for you guys, if you want to have a look at the time, if and when the market reaches the level, is 1.06 the figure, meaning 1.06000. That might be a very good entry level if you, whatever technique you're using at the time, are getting a long signal there. The risk for the trade is obviously commodity weakness in inflation data in terms of the Aussie dollar, and the yield differential turning more negative. I'm looking at the chart right now, and I'm seeing that the yield differential is not speaking for the trade yet. I'm still long, I'm already long, because not always are the yield differentials telling you that your trade is doomed, okay? And then I'm looking at commodities, a special ratio there that I'm not going to give away for free right now, and that's also pointing towards lower prices. So if I can give you a hint, I'd wait for a retracement. If you get the 106 level, that's a pretty good bet that you can hit that for a potentially very good trade. So already long my starter position here in the Admiral Markets account, and then here's a retracement level where I'm interested to add to the position. Stop loss is a little bit more. It's a 1.5 risk to reward ratio. If and when we hit this upper edge level, which I expect we're actually going to hit, it's called a floor from where the guys were long last time up here, and I expect a reaction of the price there. So if you get in at 106 the figure and you ride it up to 107, that's 100 pips, happy days. Could be happening, but again, yield differentials not quite there yet. I was quite aggressive in getting long there. Guys, let's check the clock. How long did we go? I don't know, I can't even see it. I'm blind, no idea.
We have 1 or 2 minutes more, so maybe I will give you a question from the participants. Good morning. Can you explain the relationship between treasuries yield and the stock markets, please?
Yeah, Anand, that's a very good question. Can I explain the relationship between the yield and the stock market? Yes. I'm assuming you don't speak German, because it doesn't matter. On my YouTube channel, I put out a video regarding the increase in LIBOR. LIBOR rates were increasing, and there's several factors that actually caused this. But I'll give you an explanation that is very simple for you to understand, Anand. If you sit on a long of money, you personally, you're a money manager, and you can invest in the stock market, let's say the S&P 500, and let's say you get a dividend yield, i.e. a carry, if you're investing in stocks, of 2.5%. And now the US Treasury market is offering you 3% per annum. But the Treasury market doesn't really have that much of a risk compared to the more volatile and riskier asset class equities. So money is shifting out of equities, which means lots of selling and moving into US Treasuries, because the yield differential then speaks more towards, hey, I get a higher yield at a lower risk, then I'm going to put my money there. So the global funds always go where you get the highest return for the minimal amount of risk. Hopefully that makes sense to you, that explanation, Anand. Yeah, it's a battle for money. Which asset class is the most attractive at the time? And 3% is a line in the sand. Good, you got it. Cool, excellent. Where are you from, if I may ask? Where are you from? Are you in the UK somewhere? I'm always interested in London. All right, Beatty. Hopefully you have a very solid week. Guys, excellent question. And hopefully we get to see you again next week, Monday. I super appreciate you guys coming in on a Monday morning. It's a lot of fun for me to show you guys this. And Jens, as always, thank you for the opportunity to work with you guys. It's just a lot of fun. Make some money, have a great time. And as I always say, trade smart, live free, and I'll catch you next week. Bye-bye, guys.
We are international brokers. So today at 6 o'clock CET, we have also another webinar with Jay, but in German language. So if German language is okay, just visit us on admiralmarkets.de. You can register for it. Free webinar like always, just in German language today, special with Jay on 6 o'clock CET. If not, next week on Monday, Jay will be here again. Thanks to Jay. Have a good start to the week. Greetings from London office. Bye-bye.
Jens, before we cut out, the topic of the webinar is the trading journal and analyzing your order flow at the end of the week or at the end of the month. So if you speak German, pop in. It's going to be a very good webinar. Sorry for cutting in there, Jens. Now we're off.
Bye-bye.
Bye-bye.